Good evening, sir. Welcome to the Geo Solutions webinar today, and all the listeners and viewers. When you would have seen me and Nanda for quite some time, we are happy to introduce Sunil to you. Sunil has been, a veteran, one of a veteran mutual fund industry executive. He's been with Sundaram Mutual Fund for over 2 decades, and last retired as the CEO of Sundaram Mutual Fund. And kind enough is agreed to be strategic advisor to the other solutions. And today we thought we will introduce Sunil to all of you, and take his opinion, views. I mean, his views are like all over the media today, and then we thought we will present his views to you today amidst all the chaos that is happening among us, right? So my first question to you, sir. I think you have seen the bear markets, the market corrections since 2000, right? So we have seen one in 2001 and 2002. The next one we saw in 2008 and 2009. The another one which started in late 2014, which continued till 2016, and now in 26. I mean, what happened in between 2020 is probably fooled all of us as a random event that fooled many of the investors. I mean, that overhang, we have not yet got rid of that overhang yet, but we are seeing a deep, prolonged bear market for more than 18 months now, right? So my first question is, how different is this from the 3 or 4 previous things that we have seen in the last 25 years?
I think that, first of all, leave the current geopolitical related correction due to the Iran, Israel, US out of the picture, right? Because it's a very short one, it's a sharp one, and it's basically going to be a V-shaped matter because it will suddenly get solved, right? I think Iran may capitulate something, whatever. So I don't think this will be a long drawn-out war. So I would say that whatever has happened in the last 2 weeks since the 1st of March, let's keep it aside. And we'll discuss it maybe later in the show. But your question was about the 18 months back. So let me take you back to before the geopolitical and what the situation was. What's the difference? So the difference, I would say, compared to the earlier crisis and this stock market crisis, I'm not talking about the geopolitical crisis, is that there is a, how do I put it? Let me seek for the right word. It is a very unnatural one. So that's the best word that I could come up with. Why I say this is, if you take global financial crisis, take the dot-com boom, you take, there was a significant reset of the world's growth story in which India was also impacted, and there was a sharp and severe correction as happened in Jan 2008 and all of that, right? And one of the reasons for that is that FIIs who even today after the sell-off still own, I would say, 35% of the free float market cap of the country, right, are the single drivers of this kind of a fall. And what has happened is that, why I said unnatural, is that India's domestic growth story, barring a few quarters of GDP slowdown, which happened because election-related pressure meant the government took its foot off the pedal. And so there was a quarter in which the GDP growth fell down. By and large, Indian economy has been chugging along on a good wicket. Okay. So the reason for this fall and the previous falls, right, if you look at it, is the same. It is an FII pullout from the markets. Okay. And I call it unnatural because when a country is doing well, when a country is the fastest growing country in the world among the top nations, it's very unnatural to have FIIs pull out. Right? One. Second is the degree of the FII pullout was actually much more severe than those in earlier crises. So actually, while investors may not like to hear this, the fact is that the correction has not happened to the extent that it happened in earlier crises. Because fundamentally, domestic mutual fund penetration increasing with an SIP book has actually cushioned the fall and delayed the negative returns on the investor portfolios for 18 months. If that was not there, you would have felt this pain in the portfolio like you did in 2008, much earlier, much sharper, and paradoxically might have led to a recovery also much earlier, much sharper. Because now, if you then peel the onion and look at it, now that I've explained the macro context, right? So, first is that, why did FIS pull out of India, right? So, the FIS pulled out of India for various reasons that uh, if you evaluate the situation in 2024, right, India's valuation had shot up dramatically because post-COVID, this domestic retail boom had kept pushing up the stock prices, and FIs were left with what do you call a very limited space of stocks in which to buy, and those naturally kept on going higher and higher in valuation. So it came to a point where they said that we believe in the India story, everything is looking good, understood, all that is fine, but it is not that I'm willing to pay an unlimited price for the value that India represents. At some point of time, when you calculate the discounted cash flow technique, which is used for stocks, but for a country, you can look at it as market cap to GDP, the valuation metric, right? For India, it shot up to 146% of GDP, which means that to justify paying a premium to the GDP, your growth rates have to be that much faster to justify it. So some point in that period of 2024, starting from April to September, India crossed that Rubicon. India crossed that point where they said that, look, everything that is good news about India, the demographic dividend, the Atmanirbharta coming through, a very proactive government which is managing a fiscal deficit as well as supporting capital expenditure growth, which will create a multiplier. All the good news was in the price. So when we all know that, it comes to a stage where I say, is this too good to be true? Is it that if one negative surprise, then what happens to my money, right? Because people have been buying into it in April to September at those high valuations, right? So at some point of time, you say then, look, is this price worth it? We know even in any commodity, any car, anything, right? You would desire the car, but at one point you say, yes, my desire is there, but it's too costly for my desire. So in India, that fundamental desire, so, and when more people chase this, see, if you typically look at it from a, let's say, a capex cycle perspective, right? Capacity utilization. Let's say you're in the motorcycle industry, right? And you're suddenly facing a strong demand for motorcycles. And you say that, oh, there's a 25,000 vehicles shortfall this year. The demand was much more than the supply. So you say in the next year, there will, let's say, be another 10 to 15% growth. This gap is going to widen to, let's say, 35 or 40,000 motorcycles. So having got burnt by the fact that you didn't have enough motorcycle to supply in that period, you say, I want to put up capacity. The problem is you're not alone in this world. A TVS Motors wants to put up capacity, a Hero Honda wants to put up capacity, or Hero, and a Honda Motor wants to put up capacity, a Suzuki wants to put up capacity. So all of them jump in, and in 2 years' time, when the capex are built, you're built with 1 lakh extra supply when the growth is only 35,000 as expected. So the problem, similar to the problem here, India's good story led to this everybody wanting a piece of India. But when you're buying your piece of India, by the time you come and execute your buying process, the price has already gone up. So that was the situation. And the fact that post-COVID, right, we were among those who managed COVID very well. We were the ones, because of the software companies' predominance during a post-COVID digital world, when Zoom meetings and everything was online and digital and Internet of Things was coming up. So India's software then suddenly went from a stable story to a growth story. So Indian software and tech sector went through this boom. And because of those 2021 to 24 returns, domestic investors saw those fabulous returns and thought that I've got a money minting machine here in the stock market. And that, while it's good for the country that it led to penetration and more people coming in, it reset the expectation of those people at those kind of returns. So that was the second aspect to it. So why I'm saying all of this is that, so when FIS felt it, and typically it starts with the short-term hedge funds saying that this bubble is maybe pricked, so let me go short. So that is the trigger which started in September, where short-term traders started punting on India from a shorting perspective, and that gathered momentum. So so September 2024 was a defining moment there, where FIS changed their outlook, saying, now my margin of safety in India has come down very sharply. So I would rather, when I want to place a bet on will the market go up or down, there's a 50-50 chance the market may go down. So let me hedge my bets and let me short it. So that was the first trigger. The second trigger that happened was this technology boom post-COVID gradually migrated into the AI boom. When the AI boom happened, right, it sounded like it is the next industrial revolution. It is the next big thing which is going to utterly transform. Now, what happened was, while none of this was proven at the beginning of the cycle, lots of people said this is a punt worth taking. So when they then looked at it and said which countries are AI ready or getting to be AI ready, names like China, Korea, Taiwan, right, with the nature of companies there, and the US came up into the horizon. And at that point in time, because Indian markets had just had a fabulous rally, right, our P ratios were double of those prevailing in those countries. So somebody said, let me bet on the AI boom, because as it is, I'm getting it cheap. And if my bet clicks, I'll have a multi-bagger on my hands. If it doesn't click, anyway, I'm buying at 11 PE or 12 PE market, as opposed to my. So this second thing happened. The third thing that happened in the course of this period, much later, was the Trump coming to power and the tariff situation, where for a reasonable period of time, it looked like India and America were not going to be the best of friends. And the language of Mr. Trump in his usage or continued buying of Russian oil, this didn't set a good precedent. So we all know that 40% of active FII flows to India come from the US. So naturally, a person from the US looking at it and looks at India and says, if things are not going to really go well with the Trump administration, is that growth story, a significant part of it was based on the fact that India, with a sub $3,000 per capita income and a wage cost of $1.6 per hour in manufacturing, compared to the US, which is at a $90,000 per capita income and tremendous buying capacity, with a wage bill of $30 per hour, China being somewhere in the middle. The China plus one story, which got built saying India can easily substitute China, suddenly an element of question mark came over that because of the way Mr. Trump reacted to India's continued stance of buying Russian oil. So he took a negative view on India, and multiple other reasons. We'll not go into those. So I'm just trying to identify three specific things which happened. It started with an overvaluation feeling, margin of safety correction, followed with an AI. And I will tell you one thing. There's nothing that India could have done to have prevented this. You can't tell domestic investors, don't put money in the market now. Market is overvalued, right? As it is, your penetration low, you're trying to seek more investors in. Second, we can't adopt AI because as a country, what you call a demographic dividend means that you need to provide jobs. We can't go after a thing which is going to cut jobs. As a nation, that's political suicide for any party in power. So an official blessing and a strong push to AI would immediately come up and say, no, so many jobs are going to be lost in AI, right? So why I'm saying this, India was stuck in this situation for no choice of the situation. Domestic investors coming and buying and pushing up the market, we are not being AI ready. And then when we need cheap oil, because we are 85% importing, we had to buy from Russia. How can we? Otherwise, look at what petrol prices would have happened to petrol price in India. So it's a political compulsion to buy oil from Russia. So all these three are not that when you roll back time and say, could India have played it differently? Could we have a different path? No. I think this was a necessary journey to have gone through. And today, because the war has come, at least just before the war came, it was looking like with a good budget, with the Indo-European trade deal being signed. And before the tariff judgment hit the US, we had signed a deal with America. So it looked like all of these coming together would justify the valuations and the markets would now take a rise. But this latest geopolitical crisis has now, plus the tariff crisis, I would call it, because Mr. Trump was going on a particular path. So now even the Indo-US trade deal has to be reset. We can't sign an 18% deal when the world is getting 15% tariff, right? So it's got to be reset. So I think it's just come at this time, I think, sadly, because the markets were about to start. And you look at the earnings season, I think it was fairly decent. If you look at it, not from an index perspective, by the AMFI classification of large caps, I saw that you take away the labor code was introduced this time. So there was a, one-time hit that the companies had to take. So if I factor that in, large caps grew 11% in EPS growth, top 100 stocks. Mid caps grew 16%. Small caps grew 31%. Micro caps grew 38%. So clearly, there is no slowdown in India or anything. It is on the mend. So all the things were just coming positively together. And unfortunately, this whole episode happened around Iran, which has temporarily punctured this. But I believe when the dust settles around this and things come back to normalization, all these good things which have been happening in India would come through now and fit it. But I just thought I'll give you a fairly detailed explanation of what went wrong. And so whatever has happened in the market over the last 18 months is a function of what FIS sold, but what DIS chose to buy. Right? So essentially it was, and when DIS looked at the situation and said FIs are continuously selling, right? Nobody calls, picks up the phone and tells them, everybody talks valuation, but nobody tells them that I'm not buying India because of AI. So I'm saying that the domestic fund managers, so what do they go and buy? So IT was one thing they initially started buying, right? But then later the AI threat came on to IT. They backed off from IT, but they put their whole weight behind what they felt was the local situation, which is a supportive RBI and a revival in the GST cut coming and reviving consumption and a corporate cycle, capex cycle to protect. So they thought with the softer interest rates, good credit growth, it is a banking and financial services sector which should do well. So if you see that sector has actually carried, the market would have corrected much more if not for DIS going and loading up on banking stocks. And it made it easier for them because FIs were also selling the same banking stocks, because all passive funds is 30-35% of the India index, the MSCI India index. So what the FIs were selling, the DIS kept buying, so the prices went up. So that's the sector which has actually made the market to at least remain in a decent kind of a level, failing which it would have actually corrected a lot more in terms of the headline index.
Okay. So you mentioned three things, right? The overvaluation in September 24, then AI and Trump effect, right? Probably the overvaluation is kind of corrected. We have reasonable, I mean, not fully corrected, but still, there is some fraud there. And Trump effect may be a temporary effect, maybe another couple of years or so. But in between that, AI, right? So what do you think, how India is going to get affected by AI in the long term? I mean, what is your views on that?
So I believe that as a political thing, India cannot adopt AI in all industries in India, because the need of the hour is to create jobs. Okay. So adoption of AI internally in Indian industries, the private sector will do it as it sees fit. But you won't see a government support for that in a very overt way. The right noises will be made, like the 4-day conference and all that. But honestly, let's admit the fact that if we adopt AI, getting jobs for people, yes, new jobs will be created in the AI space, but would they compensate for two things? One is job losses in the existing IT sector. Second, creating fresh jobs for the new set of youth who are coming on to the job. So I will say that India will never be a very strong AI adopting country in terms of its all processes. At the margin, in terms of where it's needed. The IT department will do it, SEBI will do it. No, everybody will do it where they want greater productivity, efficiency, but it's not something that's going to transform internal India. But where India will adopt AI with double vigor will be in the export-oriented industries. In newer areas where we want to do, right, for us to the longer, harder route to improving the skill level of our labor to get it there versus in any new export-oriented industry, which these trade deals facilitate, we would more than happy to adopt AI. So the new job creation perhaps will be less from there as otherwise would have been. But what will take care is that the quality of our production, because when you bring in AI, the error rates come down dramatically because it's anything repetitive, right? AI is geared to do, right? Replicating something millions of times. So when you do high-end manufacturing, right, from a quality productivity perspective, there I think India will adopt AI because there are no current jobs being lost there. And in a new scenario, instead of 10,000 jobs being created, you will have 2,000 jobs being created. But you wouldn't know that there was 10,000, so 8,000 jobs did not get created, will not be publicly knowledge. So I would say the export-oriented sector, and it includes even your IT companies, for example, because using AI in their solutions. For example, I'll give you an example, right? Clearly, the IT world is going to change in terms of the way the billing is done. Your per person, per hour billing is history now over a period of time. So the companies which quickly adopt to say, for the project, I'll do this. But at the back end, adopt AI rapidly so that they keep their profit margins. They could even widen their profit margins. If they go and bid for a project and then they tell the company, don't worry, whether I'm doing it through person or through AI, you leave it to me. This is your price. Outcome-based billing. Then they adopt AI internally, right? To get that done, I would say that those are the companies which will thrive and grow because their margins, the market respects only margins. From a stock market perspective, they will provide. So I would say that, so to cut a thing story short, any new venture in export is one thing which came to my mind, but even for the government, for private sector, anything that they knew, a new product line, a new area, it will be fully AI. Because the biggest problem is that my going and sacking thousands of labor is going to raise political hackles, create a lot of unrest and all of that. So the traditional employment-based industries which are not forced by competition to adapt. Now IT is going to be forced by competition to adapt. So they don't have a choice. So IT job losses are going to be there. Let's face the brutal part of it. But in other industries which are labor-oriented industries, it is not necessary that they will not use AI there straight away because they don't want to be laying off people and you creating, and the government will also not, will kind of not allow that. So I would say you will have an old India and a new India. So your traditional, your gem cutting industry, your leather industry, your textile industry, those will continue to be heavy employment driven. But any new ventures, anything that you're doing new in the space of defense manufacturing, in the space of anything, you will adopt AI very rapidly because let's face it, AI worldwide is being driven a lot by Indian engineers. So it's not like as in Indians, we lack that AI skill set, right? I mean, Perplexity is ultimately an Indian, owned company. And so my perspective that is, so for us, we'll see a sharp divide between adoption of AI in anything new where you're not going to create job losses. You will go full strength into AI. But anything where in existing, it means that, oh, I did this, so I'm laying off 100 people is going to be a red flag from a political perspective, which I would say even the private sector would try to avoid it. They will try to gently do it. They'll do VRS, they'll do some kind of separation scheme. They'll not directly correlate sacking of an employee with an AI introduction, because that's really a hot potato. So that's the way I see us growing. So for all you know, then India could be that AI engine for the developed world in completely new export-oriented areas, which will be excellent for our GDP growth and everything else. But this is the way I think we will play it.
Okay. So will we still have attraction to global investors, compared to say a market like Korea or Taiwan, who are adopting AI in a much bigger way? What will be the attractiveness of India to global investors?
think that's going to fundamentally change. It will be very sector specific and company specific, as FIS will look for those companies which are adopting AI and go. It's not an India view which is going to change, because India is not going to change that dramatically. Okay, so I don't think that FIS will start flocking to India because now India is suddenly a AI attractive destination. That ain't going to happen. But specific sectors and specific things which demonstrate the use of AI will get their allocation from a fund. One. Second is that I think there will also be a reversion to mean on this whole excitement about AI, because it's overdone. There are negative overreaction and positive overreaction. I think that this AI story has been overdone, and clearly you're seeing that in the US. For example, if you see, what is that? The top five, the AI investing companies, right? The Microsofts, the Googles, and are spending $650 billion on AI capex. Now, initially, everybody celebrated it because it came on the back of fabulous growth in the AI revenues for these companies. But suddenly now people are questioning the ROI. Just to put it in perspective, India's largest company, Reliance Industries, is $220 billion in size. And these six companies put together are investing $650 billion. So it's a huge amount of money. There's going to be a huge failure rate there, because everybody is fighting for the same pie. I take you back to my motorcycle story, right? There's this AI pie for which all are fighting and all are throwing resources. But who's going to be the winner? We don't know. So all the rest of the companies lose. All that is money down the drain. So market is suddenly getting a reality check on this mindless spend on AI capex, just as a race to the bottom. So there will be that reset which will help India, because India will then be something which never went up because of AI, doesn't need to correct because of AI. Whereas those countries will have to go through that process of boom and bust in terms of their valuation, everything else. And so then the money comes back, India will be in a better position, because we don't have AI as a threat to money coming in any longer, because it's already been there, done that. And the real bottom line, that's why I said, people then look at saying, which company is adapting AI? See, we are never going to be that company which is going to spend on this, right? India has given a tax-free status for all these data, so there'll be a lot of companies coming here and using cheap India data, the tax benefit from data, to do it in India, right? But they may not be necessarily listed in India to present a stock market opportunity from an India perspective.
Okay, so another question that is, coming from most of the retail investors, that, right, or, compared to the previous time, right, 2015, 16, or 2008, 9, or 2001, 2, you look at all over the world, everywhere the market came down, together, right? But this time it's been only India alone, right? And also added to the fact that your gold prices also ran up so high in the last 2 years, coincidentally. And this kind of puts a doubt in, Indian investors' mind that, am I investing in the right place, right? So what are your views on that, right? Especially when it's happening only to India currently, right? All last 2 years, every other markets were growing, and only Indian markets did not grow. And in fact, only Indian stock assets, only that did not grow in the 18 months. So that creates a lot of doubt in the minds of investors.
So I think that the right way to look at it is that if you took a long-term chart of a nominal GDP versus the stock market growth, you will see that in the long run, the market actually beats the stock market. The stock market beats the nominal GDP growth of any country. It's not just India specific. But the journey is not linear. Nominal GDP growth is reasonably linear, except for COVID. There's no corrections that happen in nominal GDP, right? There may be growth at 10% or at 8% or at 12%. It's the relative slope that matters, but the trajectory is upwards. But the stock market always goes through this boom and bust, this overvaluation, undervaluation, the virtuous cycle, the vicious cycle. So it's a cyclical thing. So we are, in the last couple of years, been at the wrong end of the cycle, where the GDP growth has held up at its 8 to 10% levels, but the market valuations went ahead of themselves and are going through a correction phase. So the answer to that is that if the fundamental value of a stock is not getting altered, right, which has happened to lots of good stocks in India, but the price hasn't gone anywhere, it doesn't mean it's a bad stock, right? So I think to translate the same into country situation, just because the stock market is doing badly, it doesn't mean that the country is bad or the country's markets are bad. It is that phase where people are and other than the motorcycle example, let me talk about the agricultural example, right? What happens is that potato prices go to 100 rupees a kilo. then every farmer wants to put potato for the next line of crop. But naturally, when that harvest comes, there's a glut of potatoes and potato drops to 2 rupees a kilo, right? So potato neither changed good or bad. It's still the same carbohydrate thing satisfying your hunger. Everything is the same, right? So what happens is that, so the potato farmer or the person who's investing in potato farming or whatever you want to call it, will have to go through this period of, is this the right time to put into potato or not? Correct? So similarly, from a stock market perspective, when India was doing so well, right, we were stuck between a rock and a hard place because India had delivered fantastic returns with good GDP growth, and there was no problem with the GDP growth in a real way, but market started correcting. So I would encourage you to still look at the fact that the consistent GDP growth, yes, the market overreacted at the particular point. We are going through that phase where the reaction is kind of correcting itself, right? But it will not last forever. Sometime or the other, this line has to catch up with that line. So all it needs is patience, and it needs discipline, and it needs that 3-letter word, which is called rupee cost averaging. Because it's in the down cycle that when you keep buying it, you're buying it at lower and lower prices, but you're accumulating more and more units, right? So which means that you are truly making that bad times work for you, as long as your horizon is to looking at a period that's a good time. So the key here, I would say, so as an investor, the point is, today, can I guarantee you that in 3 months' time, the market will bounce back and erase all the past losses? I cannot. Can I guarantee you that in 6 months? I cannot. Can I guarantee you in 1 year? I cannot. Can I say it in 3 years will do? I can. But the point is, can it happen before 3 years? It can. But I do not know that time frame. I know you got to wait long enough for this excesses to get absorbed in the system, right? It's like a detox. Let's say like an alcoholic detox. You took on too much alcohol and you're going through the detox period. So the point is that if you do nothing to your portfolio and keep quiet, you will end up at a certain place in 3 years' time, which will be, let's say, definitely better than. But if you actually buy during this correction period, you will get back to a profitable space much earlier than the other person, and at the end of 3 years you'll be in a much better situation than the other person. The point is that if you need the money in the next 3 months, 6 months, 1 year, that's the only way then to think that there is a level of uncertainty and I've booked profits. Is there a chance that it could go down more? There is a chance. The war could get solved in a week, it could get solved in 3 months, we don't know. Right? Then maybe whatever the need for which you had planned, you do take the money off the table. I don't want to say here, keep staying invested. It is about when do you need the money. If your need is beyond 2 to 3 years, then you make the volatility work to your advantage and keep accumulating the same goods, which are non-perishable goods. Unlike going and buying anything in the market during an Adi sale. You know, in Tamil Nadu, we have this Adi month, which is supposed to be a bad month. But typical to behavior, they give a discount and everybody rushes into buying during Adi. They forget about that's the bad month because the price is good, right? So bad month, price good. So it's exactly the same situation for the market, right? It's a bad situation, but the price is good. So buy it, but it's not a perishable. It's not something that, it's going to, if I buy a car now, it's going to depreciate in value, right? So buying a car during the Adi sale, right, versus waiting for the right car at the end of the period is completely different decision. But stocks are non-perishable commodity. As long as you are buying a company which 3 years hence is going to be better off from an EPS growth perspective than today. So there are going to be obviously companies which could have a tougher time in 2 years, 3 years. Those IT companies which don't adapt to this new business model are going to. Those which have got this socialist mentality and say, I don't want to sack my people, I'll protect jobs at any cost. They are doomed because the business model is changing. You can have a communist socialist view, then I will never sack anybody, we'll keep quiet. Or there are still IT companies which say, oh, AI is it? I don't see that as any big threat, right? So that kind of a situation can always be. Hello?
Yeah. Yes, sir.
Yeah, you can hear me, no? Oh, sorry.
Yeah, we can hear. Yeah.
So I'm just saying is that, so that's the way I would put the perspective, right? That there has been, I mean, I know the war will create some damage to our, so companies which are in the crude, their costs will go up. Our GDP growth could get a 25 to 30 to 50 basis points hit for the short run. All of that is there. But over the medium term, once you believe that this war is not a permanent thing, India's economy was actually getting back on track before and will get back on track after. At this particular point of time, it's got disturbed in the world. So your whatever incremental growth perspectives that you want to do will not translate or something. That's okay. But nothing has fundamentally gone wrong with the fabric of India, right? Everything is in the right space and going along. The market will just take some time to recognize the value of this consistent growth, this huge potential. So just be patient, disciplined, waiting out this period. But like I said, if you have time on your hands in terms of when you want to plan for your money, then this is a good time to keep accumulating right through this period of volatility.
Right. So my final question before we take, our investors' question if it comes, is there any small tweaking that I need to do right now on my portfolio because of that, war incident that has happened, or just leave it like that and just continue with my whatever the process that I had before 2 months back, just continue with that, or any tweaking required at this point of time?
There are two things I would say. One is the war and second is AI. Okay.
Yeah.
So I would say from a war perspective, right? I don't think that any tweaking is necessary as long as your investors are comfortable with the war-related volatility in the portfolio. Okay. So ultimately, it's the investors' emotions that you have to handle. So if the investors are going to feel that they want to be protected during the war-related volatility, then for those investors, you have to cater to their needs. See, end of the day, we are here for the investors, right? So to those set of moderate or conservative oriented investors who don't want to take this volatility, then to that extent, shifting to a safer oriented portfolio may be warranted, right? But to somebody else who's just building wealth for the long term, for his retirement, for his post-life planning, you don't need to tweak the portfolio. Though I would actually argue that it's a good time to accumulate the crude related stocks, but I don't think we should keep jumping and then reacting to these situations. So I would not recommend that as a portfolio manager that you do that, right? So that's number one. But on the AI part, I feel that the technology sector in a portfolio has got to be shifted from a growth oriented sector to a value driven sector. So mentally in your portfolio, when you have a composition, you'll say, to this extent, I will be in a value which the margin of safety is higher, the cushion is higher, and there'll be a growth element of your portfolio. I would say IT, if it was in the growth element of your portfolio, needs to be shifted into the value element. The reason I say this is this AI threat, what it's doing, it's actually valuing the sector as if it's doomed to extinction after 3 to 5 years. Right? Discounted cash flow, you calculate for the next 4 years, and then there's a salvage value or a terminal value which you take. It's taking that terminal value to zero. That's the way the investors have reacted to the sector. So in the next 2 years, you will actually see IT companies' earnings not get affected by AI. It's only the future prospects of it which they cannot keep guaranteeing that rate of growth. But the actual EPS growth will come in as a positive surprise and a pleasant surprise. And the dividend yields are fairly strong. Right? So there is a set of investors who look at dividend paying stocks, and IT will now come into their the insurance fund, the pension funds. So why I say this is there will be a strong element of value to the sector because the earnings for the next 8 quarters, I will say, will be by and large on thing. It's always the future which is looking dimmer, but like the light at the end of the tunnel or otherwise, the goalpost will keep shifting. And the problem is that not all the IT companies are going to survive and grow in this new AI world. So from a growth portfolio, right, you to pick the right companies, we don't know. We have to wait for them to announce their plans, to check, see what they do and do. So there's a lot of, but if you take to the pack, especially the large cap oriented IT, right, there's been a decent amount of correction. They're in a decently close to value zone compared to that. So I would say that you shift IT into the value component and see whether you're over on value, then you have to pare it down. But if you can take out something else from the value and substitute IT in it, then you can keep it. So I would put that as a more something that's not going to go away tomorrow, whereas this war is going to go away tomorrow. So I would not recommend changing anything. That tomorrow may not be actual tomorrow, it may be a month later tomorrow, but that's okay. It's going to go away. So I don't think we should go and juggle around things. Because see, one more thing, Kaushik, Nanda, is that for you as a portfolio manager to do any change, it means that you have to sell something to buy something. Right? And you're selling something now, everything is corrected in the market because there has been this risk of sentiment due to the war, which has affected investors in passive ETFs worldwide, where in the emerging market, India's share of the passive is taking a beating. So if you see, for example, yesterday's market, banking was the worst fall. Now, what has banking got to do anything with the crude? Nothing. But because passive funds were selling, that's 35% of the passive index. Whether you like it or not, it got corrected. So my point is that the whole market is correcting. So in this, now what will you sell? If you sell something which you have made a good profit, that's banking. But that's just corrected. Why do you go and sell something which is just corrected? So reaching the portfolio is very hazardous at this time, right? So to the extent that you're getting fresh money from your customers, also I would recommend that you replicate the portfolios the same way as before the war. Don't change it or tweak it for the war, because the war is entirely a temporary phenomenon. In fact, for the fresh money coming in, you might want to add on the crude related stuff. Because like I said, I don't want you to sell something to buy something. But the best bet today for a medium-term investor is all those sectors affected by the crude. Because before the war started, this war, the International Energy Agency has predicted a 3.5 to 4 billion barrels excess supply of oil in the world. So the trend of oil, this is a spike which is caused by this geopolitical uncertainty. It is not a demand-supply pull for the price of oil. So I would say betting on that the oil will come back. Only thing, you don't know when it will come back. So for newer cash coming in from aggressive oriented, longer term horizon investors, I would say yes, you can tweak your portfolio to actually buy the crude pack, right? Crude related pack, but not for any of your existing portfolio. I don't think it makes sense to sell something and buy something in this period.
Okay, thank you very much, sir. Kishore, any questions we have? We will see if there are any questions from the investors, and then
I think somebody has posted something on
I have
2008. You have replied to him?
Not yet. I have requested people to ask their questions in the Q&A window.
In the chat box.
There is a Q&A window. I've just requested people to ask their questions there. There is one question which has come up from, I think, Sachin. Yeah.
I can read the question.
All right. Great.
So it's like in 2008, FIS pulled out to 47,000 crores. They came back. COVID, 62,000 crores a month, then they came back. 2022 Fed hikes, 1.32 lakh crores, they came back. But 24 to early 26, they offered nearly $46 billion, no sign of return. This time, wars are redrawing global trade alliance, and AI is dismantling the very IT sector that made India attractive to FIS. In every past exit, the reason to come back was intact. This time, isn't the reason to come back broken? No. The reason to come back itself is there in your question. It is that they have overexposed themselves to the AI story and are now realizing their mistake, because the AI is a winner-takes-all bet. And so every company is trying to put its maximum resource to be that winner. But as a portfolio manager, they're realizing that there's too much risk, because only one is going to be a winner and there are going to be 5 losers if you just take the top 5-6 companies, right? So there's a big pullback that you're seeing. So the reason for the money to come back itself will be AI, because India was not boosted up in the AI frenzy. So it doesn't have to correct in a post-AI situation. And so when the FIs realize that they need to not just be AI-oriented in their whole portfolio, but need a more balance, then they will seek the growth, and the longer-term growth story of India remains intact. So right now, for the last few years, they have been in this frenzy, aided by India's valuation story and by the Trump natak, if I may call an Indian word. But as you can see, Mr. Trump is now quite favorable. He's allowed us to buy Russian oil. Okay, the same Trump would charge 25% tariff is now saying, okay, 30-day window for India to clear Russian oil. In fact, he's probably likely to do that to all countries to buy Russian oil because he wants to keep domestic oil prices under control. So what I'm saying is, so Trump-India relations are now no longer on a bad keel. They are on an even keel. India's valuation, thanks to all of this correction, has come down to more reasonable levels. And the government has initiated a lot of steps, right from the GST cuts to income tax related cuts to put money in people's hands, to having a very supportive RBI which front-loaded the rate cuts, to signing up deals with 25 other countries, of which Indo-UAE deal was the biggest. And there's optimism that when this tariff Jamela settles, India would come away with a reasonably good deal with America also. So with all of these positives are there, they'll get their rightful attention in a world which is just reacting to AI, right? India will get back its money in a reasonably good time frame. So I would say the very reason the money went out of India is the reason the money will come back to India. That's the law of nature and life. That's the way it is. And if you see the commentary from a lot of big global equity heads, I don't want to take names here, all of them are saying that India is the market to be in for the future. So be patient. FIs will come back. Don't expect a V-shaped FI recovery. They will take time to readjust and come back, but they will come back. Don't. Yes, it was an extended winter for FIs in India. Agreed.
Both the questions are about gold, sir.
Yeah. So I would say that look at it this way, right? Gold, if you see in the geopolitical crisis, hasn't gone up. So lots of questions actually I have been saying, why has gold not gone up so much in this latest geopolitics? Because everybody is up to their neck with gold. How much more of a safe haven we should now add up? You already added up for other reasons on gold. There's no one. Second is, in this geopolitical crisis, the dollar is turning out to be the safe haven, right? The third thing around this short-term situation around gold is that the correction in the equity markets meant a lot of margin calls had to be made. And to meet those margin calls, a lot of traders in gold had to book profits to take that money and meet their margin calls in all those Taiwan, Korea, wherever the markets they had taken a punt on, right? So this is a readjustment cycle for gold that's happening. That's why it's not running up. But look at the factors. Leave this geopolitics aside. Like I said, it's not really. What is the real reason for gold to rise? The real reason for gold to rise is nothing but de-dollarization. It is the only alternative currency. Until Mr. Trump is in power, people will hesitate to trust dollar assets as being safe from being frozen. And the second thing is that since Mr. Trump is so heavily pushing for a rate cut, right, the dollar is slated to then the lower coupons from investing in dollar debt, plus the dollar being weakening is a positive for gold, right? So I think the Trump factor is that one factor, both in terms. Then the third aspect there is that over the next year and the next year, 26 and 27, right? It's actually this year for a calendar year. There's a huge amount of US Treasury debt falling due for refinancing. I am not so sure that Japan, which holds $1 trillion of US debt, and China, which holds 800 billion, they have been gradually liquidating and buying gold or using all their surpluses to buy gold. But they didn't want to make a big $100 million sale of treasury in the secondary market because that would cause its own earthquakes in the market and cause it to crash even further, eroding their values. But I suspect that they will not be so enamored of just going and renewing a 10-year debt with the US. So when those bills fall due, right, what was issued 10 years ago in 2015, the US 10-year bill will fall due this year and next year. That's a significant proportion. There are slides doing the rounds, and I can probably send it to them later if they're interested. But I'm saying we have to wait and see how many countries are willing to subscribe to it. And if that's not the case, then the huge threat to the US is how are they going to refinance that? And given Mr. Trump's past behavior, one can't rule out the possibility of his revaluing the Fort Knox gold reserves to shore up his balance sheet of America. And that will be taken very negatively by the world, that the US doesn't have money and is doing window dressing to set their balance sheets. I hope he doesn't go down. As a very remote percentage probability of him doing that. But knowing Mr. Trump, there have been so many things that have been remote possibilities which have happened. So the Trump uncertainty factor will lead to gold continuing to be held in decent amounts. So do not expect the kind of 50-60% return in gold or 150% returns in silver, but expecting a double-digit kind of returns from gold is not out of the way. So I would say that in an asset allocation, gold should remain a part of your asset allocation. What proportion? Based on your risk appetite, based on your thing, you can decide. But I would say don't go and liquidate gold completely from your portfolio at this time.
Okay, we'll probably take just one or two more questions. Sunil, I'd be thankful if you can also touch upon silver on this and US markets.
So silver, okay. Yeah, sure. So silver for me, is basically a story built up. It is actually a small cap stock in the parlance of the word, right? Why do I say that? So when things are good, it runs up very fast. When things are bad, it can crash very fast. And the reason for that itself, the reason for its rise is this whole industrial usage bit. So when you talk about industrial usage, right, it is cyclical. Every product which is otherwise dependent on industrial usage, it's cyclical. Your non-precious metals, right? It's cyclical. So today, because there is a safe haven spillover from gold to silver, and because there is a much touted supply shortage of silver, saying that nothing new is happening, it's got a tailwind just like a small cap stock. So the small cap stock rises, it's a high beta stock. So silver is a high beta gold. So it's just rising faster. But if for any reason, due to this turmoil, anything, there is a correction to the whole, the world of EVs, the world of where the demand comes from, and there's a natural cyclical downtrend in industrial demand, silver will fall like you, and there's no tomorrow, right? When that will happen, how that will happen, I don't know. But it is a much riskier, more volatile asset. So just like a small cap stocks, right? It will rise very fast in the run up, but it can fall very fast in the down run. I don't have a clear cut negative for silver saying this can happen and so it will fall. All I'm saying is that as a small cap stock, it's already risen. It's now at a high valuation. It's like India in 2024 September. Okay, it's in a high valuation story. Something can prick the bubble. Suppose the industrial usage world feels that, I feel that though silver is a better conductor of electricity than copper or aluminium, but that's okay. At the price at which silver is quoting, if I use double the amount of copper also, I'll still manage its copper. Then what happens to silver demand? I mean, these are all imponderables on which you can't sit and draw an Excel sheet and a chart. All I'm saying is the ride has been good. It's a roller coaster. The roller coaster ride has been good. You've made your money back.
Looks
right?
like Sunil's connectivity has become a bit of a challenge.
No, it's
let me just check
Kishore,
if he is rejoining.
Kaushik, you can
parallel.
hear me, no?
yeah.
No, it's Kishore's
And
connectivity.
Kaushik, if you would want to fill in here at this point.
Yeah, no, he's clear. Hello.
I'm there.
Yes, sir, you can continue.
Yeah. No, I talked about silver already. What is the next question? Was there another question?
Next question is will US market crash impact Indian market? And also, should we consider US in investing in US indices or US markets?
I don't know why he's talking about what US crash is he talking about? This geopolitical crash.
If there is a US crash, will it affect India?
Absolutely. See, the US is the what do you call the bellwether stock, right? It drives so when there's a positive move to risk on, US gets a benefit, then it spills over to emerging market. To think that in a US market corrects will be a good contra bet, no. The investors in the US, they are facing the pain in the US. They'll go risk off if the US doesn't deliver. So if the US market corrects, yes, India will also, the whole emerging market, world stock markets will be under pressure. Okay. Second point of it is that, what is the second half of the question?
Second is, should I invest in the US market for diversification?
I would say yes, because if you see the US earnings growth projections, they're fairly double-digit earnings growth projected for this year and the next year. It's only the AI-related heavy capex where there's been suddenly a vulnerability, then people questioning the ROI of that AI capex. But otherwise, if you see in the regular US market, earnings growth is fairly robust and good. So I would say yes, the US, the correction which has happened in the US due to geopolitical things, right? It's a good opportunity to invest, but don't go chasing the whole NASDAQ technology index. I would say the S&P 500 and to some extent the Dow, because materials and all those are expected to do well, I think would be better bets rather than just a NASDAQ oriented.
So that's pretty much, sir. We have the questions. I think we are also closer to 9 o'clock now.
Yes.
It's been an hour that we are, talking about it. Thank you so much. And just one, a quick, your advice to all our investors who've been present in this session. Very small advice for them.
No, my advice to them is that, look, crises come and go. As long as crisis doesn't alter the fundamentals of the economy, right? You always, as a long-term investor, you don't buy stocks, you buy businesses. You buy businesses in an environment which is pro-business, which is the country's environment. So I think India has a lot of good businesses in a very greatly supportive macroeconomic environment of a government which is conscious of the riskiness of the country, hence is keeping the fiscal deficit constant, has got the right set of tools which is doing to help the economy go forward. So to that extent, and India, in the rest of the world, why are they all lining up to sign up trade deals with India? Everybody recognizes the value of India. So ultimately, you're buying India. You're buying this business called India. And in that business, right, the price keeps fluctuating for that business's value. The value of the business is not suffering. The enterprise value of the business remains strong. So based on whether you're an aggressive or moderate investor, if I wouldn't say conservative, because if you're conservative, you probably shouldn't be too much into equities itself as an asset class. So between aggressive and moderate, I would say for the moderate person, you hang in there. The aggressive person, I would say that allocate your cash balances in a small proportion to the portfolio that has been built before the geopolitical event happened. Staggered manner right through this crisis is the smart money. That's what the smart money will be doing. So make your excess cash work smartly, but do not rejig your portfolio at this point in time. Do not try to sell one part of your portfolio and buy, taking a bet on this, because honestly, the future of the war is not in anybody's hands. When will Iran throw in the towel? When will US throw in the towel? If so case, maybe we don't know. We are not in the business of politics. But the politics has led to an opportunity to buy. But because it's an uncertain time of buying, stagger your buying for an aggressiveness. So that's my limited advice to investors.
Yes, sir. Thank you so much, and good night. And thank you for being part of the session. Thank you.